Hi, welcome back to Cheryl Trades LEAPS. Imagine a stock falls 15%. Your LEAPS contract falls 50. You were right about the company, you still lost money. That is the paradox of LEAPS investing. Leverage cuts both ways. It can build a fortune. It can also destroy a portfolio that was built on a correct idea and a careless execution. Today, I am giving you all 27 principles I believe matter most when investing with LEAPS. Not theory, not hype. The actual framework that separates investors who compound wealth over a decade from investors who blow up one account at a time. Let's get into it. So, why LEAPS are different? LEAPS can create extraordinary returns. They let you control more shares with less capital. They give a long-term thesis time to develop. But that leverage cuts both ways. A stock can fall 15% while your contract falls 40, 50, or more. You can be completely correct about the company and still lose money. Wrong strike. Too much volatility paid. Bad valuation at entry. Waiting too long to manage expiration. Successful LEAPS investing is not about finding a great company. It is about combining business analysis, valuation, timing, position sizing, risk management, and emotional discipline. The investors who survive are not the ones who find the most exciting stocks. They are the ones who avoid catastrophic mistakes, protect their capital, and give strong businesses enough time to compound. I've organized these 27 principles into 5 sections: foundation and edge, valuation and entry mechanics, risk and thesis management, behavior and long-term process, and advanced tactics. Let's start with the foundation and edge. This section is about what has to be true before you ever look at a strike price or an expiration date. Your reason for buying, your capital protection, your process, and the business underneath the contract. Principle 1. Invest in the thesis, not the prediction. Many new LEAPS investors think their job is predicting exactly where a stock trades next month. They try to call the bottom. They try to predict the earnings reaction. They try to anticipate every Fed meeting, every inflation report, every headline. Nobody predicts every short-term move consistently. Nobody. Your real job is building a thesis that survives uncertainty. Why should this business be worth more in the future? What drives revenue and earnings growth? What is the competitive advantage? What could permanently damage the business? What evidence would prove you wrong? You are not buying a contract because you know what happens tomorrow. You are buying it because you believe the company creates more value over the life of that contract. Short-term price movement is noise. Long-term business performance is the signal. Principle 2. Protect capital before chasing returns. The first question most investors ask is how much they can make. The more important question is how much they could lose. A LEAPS contract can lose most or all of its value. That does not mean avoid them. It means size them properly. Your first job is not maximizing upside. It is making sure one bad position cannot permanently damage your portfolio. You cannot benefit from compounding if one oversized trade wipes out years of progress. Decide how much you are genuinely willing to lose before you enter. Size the trade off that number, not off how confident you feel. Confidence is emotional. Position sizing is mathematical. Principle 3. A real edge is repeatable. There is no perfect indicator, no secret strategy that wins every time, no strike price that eliminates risk. A genuine edge is a repeatable process that produces favorable outcomes across many investments. Maybe your edge is buying quality companies during temporary fear. Maybe it's catching earnings growth before the market prices it in. Maybe it's waiting for low implied volatility before buying long-dated calls. The exact process can vary, but it has to be repeatable. If every purchase has a different reason behind it, you do not have a strategy. You have a collection of opinions. A repeatable process usually includes a strong balance sheet, sustainable revenue growth, improving margins, attractive valuation, reasonable implied volatility, a favorable technical entry, and enough time until expiration. The edge is not any one of these. The edge is the combination. A repeatable process beats a collection of opinions. Principle 4. Understand the business before the option. A LEAPS contract is only a financial instrument. The real asset behind it is the business. Before you study delta, theta, or open interest, understand the company. How does it make money? Who are the customers? Is revenue recurring or cyclical? Are margins improving? Does it generate free cash flow? Is there too much debt? Is management allocating capital responsibly? A beautiful options chain cannot rescue a weak business. Price action determines your entry. Fundamentals determine whether the investment deserves your patience. Never buy a contract just because the premium looks cheap. Sometimes it's cheap because the business deserves to be cheap. Section 2. Valuation and entry mechanics. This section is about the mechanics of the trade itself, what you pay, how much time you buy, which strike you choose, and how volatility and position size shape the outcome before the stock even moves. Principle 5. Valuation still matters. A great company can still be a bad investment at an extreme valuation. LEAPS. Investors focus so much on future growth that they forget how much optimism is already baked into the current price. Ask what assumptions are already embedded in the stock price. How much growth does the company need to justify this valuation? Is it expensive against its own history? Is it expensive against similar businesses? You do not need the exact fair value down to the dollar. You need to know whether you are paying a reasonable price for the future you expect. The best LEAPS investments usually start when a strong long-term story meets a temporarily attractive valuation. Principle 6. Buy enough time. Time is one of the most valuable assets in a LEAPS position. It gives the company room to execute. It gives the stock room to recover. It gives your thesis room to develop. But not all expiration dates offer the same protection. 9 months can technically qualify as long-term. It can also become a short-duration trade after only a few months pass. If you think a thesis plays out over 12 months, buying exactly 12 months of time leaves no margin for error. Earnings get delayed. Product launches slip. Rates stay elevated longer than expected. The market stays irrational longer than expected. Time does not eliminate risk. Insufficient time creates unnecessary risk. Principle 7. Choose the strike intentionally. The strike determines how aggressively leveraged your position is. Far out of the money calls look attractive because they're cheap. Cheap does not mean low risk. Low delta, high sensitivity to sentiment, a much greater chance of expiring worthless. For most long-term investors, an in-the-money or moderately in-the-money contract offers a better balance. Higher delta means it behaves more like the stock, more intrinsic value, less dependent on a dramatic move, more room to be approximately right instead of perfectly right. The goal is not the largest number of contracts. The goal is the highest quality exposure. One strong contract beats 5 lottery tickets. Principle 8. Understand implied volatility before buying. You can be right about the stock and still lose money on the option. That happens when you overpay for implied volatility. If you buy when implied volatility is unusually high, the stock can rise while your contract gains far less than expected. In some cases, the stock rises and the option still loses value once volatility collapses. This matters most around earnings, product announcements, and major market events. Ask if implied volatility is high or low against its historical range. Ask if you're paying for excitement that may disappear. Ask if waiting until after earnings gives a better premium. Price matters, strike matters, expiration matters. Volatility is also part of what you're buying. Principle 9. Know your maximum position size. LEAPS create the illusion of diversification. You might own contracts in 5 companies. If all 5 depend on the same macro environment, you really own one concentrated trade. Tech stocks move together. AI stocks move together. High-growth names all struggle together when rates rise. Set a maximum allocation per company. Set a maximum per industry. Set a maximum for LEAPS as a percentage of your total portfolio. then respect those limits. A position should never be so large you cannot think clearly about it. When a position controls your emotions, it is controlling too much of your portfolio. Principle 10. Assume the premium can fall 50%. A normal stock correction can cause an extraordinary options drawdown. The stock falls 10 or 15%. Your contract falls 30, 40, 50%. That does not automatically mean the thesis is broken. It means leverage is working against you. Before entering, imagine the contract losing half its value. Would you panic? Would you sell impulsively? Would you lose sleep? Would you start searching social media for reassurance? If the answer is yes, the position is too large. A proper LEAPS position is sized, so volatility is uncomfortable but manageable. You do not need to enjoy drawdowns. You need to survive them without abandoning your process. Section 3. In this section, we will explore risk and thesis management. Principle 11. Separate price damage from thesis damage. A falling option price does not always mean the business thesis failed. The market falls, rates rise, a sector falls out of favor, investors take profits, the company beats and still guides cautiously, valuation compresses, fear temporarily overwhelms fundamentals. When the position falls, do not ask first how much money you're losing. Ask what has changed in the business. Has revenue growth deteriorated? Has guidance come down? Has the competitive advantage weakened? Has the balance sheet gotten dangerous? Has the original catalyst disappeared? Price damage is painful. Thesis damage is dangerous. Learn to tell them apart. Principle 12. Define fundamental invalidation before entry. Every investment needs a reason to exit. For LEAPS, invalidation cannot rely only on a chart level. A stock can break support and recover. A business can stay above support while its fundamentals quietly rot. Your invalidation criteria should include business conditions. Revenue growth falling below a critical threshold. Margins deteriorating for several quarters. A major customer leaving. Debt rising past a sustainable level. Management credibility breaking down. Write these conditions before you enter. If you wait until you're losing money, your emotions will rewrite the thesis for you. Principle 13. Do not average down automatically. A lower price does not automatically create a better opportunity. Sometimes the market is overreacting. Sometimes the business is actually deteriorating. Before adding, repeat the entire analysis. Would you buy this today if you didn't already own it? Has the valuation improved? Is the thesis still intact? Is expiration still far enough away? Is implied volatility reasonable? Averaging down should be a planned decision, never an emotional reaction. Never add just to lower the number on your average cost. Your cost basis does not determine the company's value. Principle 14. Build positions gradually. You do not need to enter the entire position at once. LEAPS are volatile. Even an excellent entry can quickly get cheaper. Scaling in reduces timing pressure and preserves flexibility. Start with a partial position near support. Add only if the thesis stays intact. Add again once the company confirms the story through execution. This lets conviction grow with evidence. It also prevents one poorly timed entry from consuming all your capital. Being early with a small position is manageable. Being early with maximum size can be destructive. Principle 15. Do not chase explosive moves. A stock rips 12% in a week. Social media gets loud. Analysts raise targets. The options chain gets expensive. Suddenly waiting feels unbearable. That is usually exactly when discipline matters most. Chasing means paying a higher stock price, often higher implied volatility, entering farther from support, and giving up margin of safety. A great company does not require you to buy it on the most emotional day. There is usually another pullback, another earnings reaction, Another correction coming. Missing one move does not destroy your future. Buying recklessly can. Principle 16. Respect earnings risk. Earnings move both the stock and the premium violently. A company can beat and still fall. It can miss a metric and rally because guidance improves. It can report great numbers while implied volatility collapses anyway. Before holding leaps through earnings, decide if the event is part of your long-term thesis or an unnecessary short-term gamble. Is the position already profitable? Is implied volatility elevated? How large is the position? Would you still want to own it after a 20 or 30% premium decline? Decide before the announcement, not while watching the stock move after hours. Principle 17. Manage expiration before it becomes an emergency. Long-term options do not stay long-term forever. 9 months left becomes 6, 6 becomes 3. Theta accelerates. The stock has less time to recover. Do not wait until the final months to create a plan. Review the position well in advance. You can take profits, close the contract, roll to a later expiration, convert to shares, reduce exposure, or keep holding because the contract is deep in the money and the thesis remains strong. Expiration management should be proactive. A good thesis can still become a bad options position when time runs too short. Section 4. In this section, we explore the behavior and long-term processes essential for successful investing. Principle 18. Let winners compound, but do not go blind. Selling too early kills the power of a major winner. Holding forever can let a large gain disappear. There is no single rigid rule. Manage based on valuation, thesis, expiration, and portfolio size. If the stock rose but valuation stays reasonable and the business keeps executing, holding may be justified. If the position has become an oversized share of your portfolio, trimming may be responsible. If the market is pricing in unrealistic growth, taking profits may protect you from future compression. Let winners work. Do not confuse patience with refusing to reassess. Principle 19. Think in portfolio outcomes, not one contract. One LEAPS investment does not define your ability. A good decision can lose money. A poor decision can make money. Randomness affects every individual outcome. What matters is the quality of your decisions across many positions and many years. Did you buy strong companies? Did you control position size? Did you avoid excessive implied volatility? Did you give the thesis enough time? Did you exit when the facts changed? Judge your process over a meaningful sample. Do not rebuild your strategy after one loser. Do not believe you've mastered investing after one huge winner. Principle 20. Keep a LEAPS journal. Memory is unreliable. After a position moves, it's easy to rewrite your original reasoning. A journal protects you from that. Before entering, record the company, stock price, strike, expiration, premium paid, delta, implied volatility, earnings date, valuation, thesis, expected catalysts, risks, invalidation conditions, and your plan for adding, trimming, rolling, or exiting. Then, review it regularly. You'll start seeing patterns. Maybe you consistently buy before earnings when volatility is high. Maybe your best results come from deeper in the money contracts. Maybe you sell winners too early. Your journal turns experience into evidence. Without it, you repeat the same mistake while believing every situation is different. Principle 21. Follow your own plan, not the crowd. The market is full of opinions. Someone is always predicting a crash. Someone is always predicting a melt-up. Someone always claims one company is the next trillion-dollar name. Excitement is not analysis. A popular ticker is not automatically a good investment. A respected investor's conviction does not replace your own research. A viral post does not know your risk tolerance, your expiration date, or your cost basis. Use outside information to challenge your thinking, never to replace it. If the valuation is unattractive, wait. If volatility is too high, wait. If the thesis is unclear, wait. The crowd will not protect your portfolio. Your process has to. Principle 22. Survive long enough for compounding to work. This is the principle that connects everything. Successful leaps. Investing is not about finding one perfect contract. It's about repeatedly gaining leveraged exposure to strong businesses without letting leverage destroy you. Protect your capital, understand the company, respect valuation, buy enough time, choose the strike intentionally, watch implied volatility, control position size, manage expiration, exit when the thesis changes, stay emotionally stable when the market gets uncomfortable. The greatest advantage of leaps is time. Time only helps investors who survive. Section 5. In this section, we delve into advanced tactics for more sophisticated investment strategies. Principle 23. Know the break-even price, but do not obsess over it. Many leaps investors get emotionally attached to the break-even price shown by their broker. But the expiration break-even is not necessarily the price the stock must reach for you to make money. Before expiration, the contract still holds time value. You can often sell profitably even while the stock sits below the stated break-even. At the same time, reaching break-even at expiration is not a strong goal on its own. You took on real risk just to get your original capital back. Use break-even as a reference, not as your thesis. Ask instead if the business is progressing as expected, if the contract is gaining value at an acceptable rate, if the remaining upside is still worth the risk, and if the capital could earn more elsewhere. Never hold a weak position just because you're waiting to get back to even. Principle 24. Compare the leaps with owning shares. A leaps contract is not always the best way to express a bullish view. Compare it with owning shares before you buy. Shares do not expire. Shares may pay dividends. Shares are less sensitive to implied volatility. Shares let you wait through a long recovery without rolling anything. Leaps can be more attractive when you want capital efficiency, a defined maximum loss, or leveraged exposure to a high-conviction idea. Shares can be better when the stock is highly volatile, the premium is expensive, the dividend matters, or the thesis needs several years to play out. Do not choose leaps just because the percentage gain looks bigger on paper. Choose the instrument that actually fits the thesis. Principle 25. Watch liquidity and the bid-ask spread. A strong company can still have a poor options market. Some leaps contracts carry wide bid-ask spreads, low open interest, and almost no daily volume. That creates hidden costs. You pay too much going in. You get too little coming out. In a volatile market, that spread can widen fast. Use limit orders instead of market orders. Avoid chasing the ask. Look for contracts with reasonable open interest and manageable spreads. The displayed option value is not always the price you can actually get. A profitable thesis can still be weakened by poor execution. Principle 26. Measure opportunity cost. A position does not need to lose money to become a bad investment. It can just sit sideways for months while better opportunities pass you by. Leaps. Capital is limited, and every contract competes with everything else that money could be doing. Ask regularly, would you open this position today? Is the expected upside still attractive? Has the thesis gotten slower or weaker? Is time value bleeding away without enough progress to show for it? Could another investment offer a better risk-adjusted return? Patience is important. Patience should not become captivity. Holding a position simply because you already own it is the sunk cost trap. Capital belongs where the future opportunity is strongest, not where the past decision was made. Principle 27. Have a rolling plan before you need one. Rolling is not automatically a solution. A roll is 2 transactions. You close the existing contract, then you buy another one with a later expiration or a different strike. Rolling a losing position does not erase the loss. It realizes the old loss and commits fresh capital to a new trade. Before you ever enter the original position, decide when you'll start evaluating a roll. How much time is your minimum? Whether you'll only roll if the thesis stays intact, whether you'll roll up after a major gain, how much additional premium you're willing to commit, and when you'll close instead of rolling. A roll should be based on how attractive the new contract is on its own, not on avoiding the fact that the old one lost money. 27 principles. One idea underneath all of them. LEAPS investing should feel slow. Research carefully. Enter patiently. Size responsibly. Monitor the business. Let time do the work. That doesn't sound exciting, but boring, repeatable discipline is what actually creates extraordinary long-term results. These principles are shared for education only. LEAPS involve substantial risk, including the possible loss of the entire premium. They are not appropriate for every investor or every financial situation. Knowing these principles is the easy part. Following them when your contract is down 40%, the market is panicking, and your emotions are screaming at you to act. That's the real test. That's where successful LEAPS investors separate themselves from everyone else. If this helped you, subscribe. I break down LEAPS strategy, trading psychology, and market structure every week. Thank you for watching, and I'll see you in the next one.